the narrow focus I'd like to start with, since it's the topic of the day, is the dollar.
Mhm.
And, I'm going to throw red meat to the wolves here by citing a headline across Bloomberg earlier from Larry Summers talking about how the dollar can continue to move higher because the US has all these great fundamental advantages. This comes, 24 hours after another Bloomberg headline talked about the unstoppable strength in the dollar. So there's the red meat for you, and I'll let you gnaw on that for a little bit.
Well, it may come as a surprise. I think Larry Summers was half right, and I've met him a number of times. He's a brilliant guy. He's always, I almost always agree with his analysis and then disagree with his policy. So I always have to stop halfway with Larry Summers. Like, good analysis, Larry, but you're going the wrong way. But yeah, I think he's right that the dollar will get strong. Is probably correct. Also, where I disagree, and this is critical, is the reason why. The dollar's getting stronger for some very bad reasons, meaning bad in terms of the macroeconomy, what probably lies ahead, what is probably telling us. So let's just maybe step back and not be Larry Summers for a minute, but just be everyday investors and asset allocators and analysts and say, and I hate to use the word conundrum because Greenspan used it, but conundrum is a fancy way of saying I don't really understand what's going on. But this is a conundrum for a lot of people because they look at it, the U.S. objectively, okay, our debt to GDP ratio is over 130%, highest in U.S. history. Tons of research coming from obviously Ken Rogoff, but really Carmen Reinhart, Vincent Reinhart, and others, but many others, not just them, that says at those debt to GDP ratios, you can't grow. You can maybe refinance and muddle through, but it always ends either in default, which is unlikely because we can print the money, that much is true, or extreme inflation where here's your $1 trillion back, good luck buying a loaf of bread. So we'll see how that plays out. But the way it's playing out in real time is that the U.S. Economic growth is incredibly weak. So we've got sky high debt to GDP ratio. By the way, when you look at other countries in the world, you say, okay, who's at that lunch table? 130%. The answer is Lebanon, Greece, Italy. Those are your lunch partners, so to speak. And
This
not,
is
not
like
a,
the scene from Animal House. Would you like to meet
yeah.
Clayton, Jagdesh, and Muhammad?
That's that's a good comparison. Um, Economic growth is weak. We're in a recession. I don't care what Janet Yellen says. I don't consider her expert on the topic, but we've had our 2 consecutive quarters of declining GDP. Like it or not, that's the definition of recession. The fact that the National Bureau of Economic Research, which is a private group, by the way, but they're the recognized referees on recessions and recoveries, the fact that they haven't said so doesn't mean anything because they never do say so until 9 months or a year after it happened. And for that matter, most recessions are 2 quarters, some 3, some have been longer, but most recessions are a couple of quarters. The National Bureau of Economic Research usually declares a recession after it's already over. Like it started, it happened, it's over, we're in recovery. And they go, oh, by the way, we had a recession last January. Okay, so they'll probably get back to us, I would bet heavily after the election. But
Uh-huh.
we'll hear from them at some point. But we're in a recession now, and people say, what about the third quarter? And it's interesting because I do put some weight on the Atlanta Fed GDP now. I do think it's a very good tool. They miss sometimes, they're not always accurate, but it's the best tool out there. But very few people understand their statistical technique. Because what Wall Street does, you get a whole bunch of components for GDP, and they come in at different times with different lags, and you add them all up and you get GDP. And what Wall Street does, they look at what they have and they project all the rest based on regressions and correlations, which don't necessarily hold up. But they say, okay, here's what we think. Here's our forecast for third quarter GDP based on projections of what we don't know. Atlanta doesn't do that. Atlanta takes what we do know, hard data, and they ask a different question. They say, what would GDP be now if this was all we had? And they put out a number. But they don't guess at the stuff they don't have. And it fills in as it goes along. So it's much more Bayesian in that sense. But because of how the data comes out, the time sequence to which the data comes out, it typically fades as the quarter goes on. It's not because they're using bad methodology. It's just because that's how they do it. And so just in the last week, 9 days or so, it went, everyone was cheering. I think with September 1st, it was 2.3%, maybe a little higher, but about 2.3%. 2 days later, it was 1.6, and now it's down to 1.3. So it's following that pattern. I would expect by the end of September, we still got 3 weeks to go, given what I said about how it fades, it doesn't have to be negative, but it could very well be negative, maybe 3/4 of decline in GDP. But whatever it is, it's going to be weak. So if it's positive, 2/10 or 3/10, I mean, that's okay, but you're still a rounding error away from recession. It doesn't mean the problem's over. So debt to GDP is sky high, economy weak at best, probably out of recession in the first half. Maybe that's continuing. People talk unemployment close to an all-time low, went up a little bit in the last report. Yeah, but even at 3.5% or so, that is extremely low. I mean, I go back to the 1960s, and that was low by the measures of the 1960s. But that completely ignores probably 8 to 10 million Americans who were perfectly able of having jobs and working, prime age 25 to 54 years old, who are not in the workforce.
Yeah.
That measure is picked up in labor force participation rate, which is low. I mean, that peaked around 70% in 2000, up from the 1970s, and that was women coming into the workforce and other factors. But now it's down to around 62% and change. It ticked up a little bit in the last report, but it's still extremely low. It's never 100. I mean, there's always, you could be a homemaker, a student, they're retired, early retirees. There are a lot of reasons people aren't in the workforce, but not taking 10% off or 14% decline from the starting place in over 20 years. That's so if you throw those people into they're not called unemployed because they're not looking for jobs, but if you threw them in, unemployment would be closer to 10%, which is a recession or a depression level, actually. And I could go on, but the point is there are all kinds of signs of weakness. So, if we have the deficit, where the baseline deficit is $1 trillion. That's before an extra $2 trillion for Trump's COVID relief, an extra $3 trillion for Biden's COVID relief, if you include the ludicrously named Inflation Reduction Act,
Right.
and the American Rescue Act, and the Infrastructure Act. Call it what you want. It's still $3 to $4 trillion.
Yeah.
2 for Trump. That's 6 on top of 2 baseline. That's $8 trillion in 2 years. So your deficit's out of control, and your trade deficit's out of control. So what's not to like? And yet you look at all that and say, "What? Are you kidding me? I mean, get me out of the dollar. Go get anything else." Why is the dollar so strong? And the answer is, for this, you have to go behind the curtain. You have to look into what's called the plumbing of the international monetary system. And I had a discussion, and this goes back, this is 1980. So I'm an young, up and coming vice president of Citibank. That's back in the days when it was a bank before they turned it into a hedge fund. So I'm like a 27 or whatever, a 28 maybe year old lawyer. But I'm talking to Walter Wriston. It's a one-on-one conversation. He was, for those who don't know the name or don't recall, he was probably the second greatest banker of the 20th century after Pierpont Morgan. So I'll give Morgan the prize, but he left around 1910. And Wriston was the inventor of the Eurodollar. The negotiable certificate of deposit. Eurodollars are around a little bit earlier, but he took the CD that was your interest in the Eurodollar and made them negotiable and tradable. So I'm having a conversation with him, and I had just seen this movie, which I highly recommend. Chris Christopherson, Hume Cronin, and Jane Fonda. It's called Rollover, and it's again 1980, but all-star cast. Yeah, I got a murder mystery, a little sex thrown in, but it's basically about the collapse of confidence in the U.S. dollar. And Hume Cronin plays the Walter Wriston part, and basically the idea was remember, this is during the Arab oil embargoes and the Iranian oil embargo, and price of oil quadrupled in 8 years and all that. So the theme was the Arabs are taking the money out of the banking system and buying gold, and they're stashing the gold away. And this is the collapse of the financial system. And that was sort of the plot. So I said, Mr. Wriston, what about that? Everyone took their money out of the system and bought gold. Wouldn't that collapse the system? And he looked at me like I was a new kid on the block, which I was. And he said, well, What you have to understand is that you can take your money out of the bank and you can buy gold. But the person who sold you the gold got the money and they put it back in the bank. So it doesn't go anywhere. It's a closed circuit. And of course, now I'm like, oh yeah, you're right. Of course, he's right. And he said, so the stability of the system doesn't depend on who sells what for dollars. Yeah, it affects exchange rates a little bit and interest rates with the price of gold. But he said the money always, it can't literally disappear. It has to go back into the system. It's a closed circuit. And of course, that's how the Eurodollar system works. The Fed will not be able to get interest rates to 5% without causing a recession, not to mention the impact on the deficit and a lot of other things. So the Fed can't escape the room. So if inflation stays where it is, the Fed can't get interest rates to a real level without causing a recession, which will sink the stock market. But even if inflation comes down a little bit, that'll be a sign of recession. So you're raising rates into a recession, which will cause a recession. You end up in a recession either way. It's just a question of whether the Fed persists or throws in the towel. Now, we've seen this movie before. What's going on is an exact replay of what happened between 2013 and 2019. May 2013, Bernanke announces the taper. Expectation is they're going to start the taper in September. He chickens out. They start the taper in November 2013. They finish the taper in November 2014. Then here comes Yellen. She's going to raise rates. Take out the word patient from the statement. She doesn't raise rates until December 2015. And then she doesn't raise them again until December 2016. They went a whole year between two 25 basis point rate cuts. And then here comes Powell, and then boom, okay, 25 basis points, boom, 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 gets them up to 2.25, which is where they want it to be, and gets the balance sheet down to about $3.5 trillion. They want to get it down to about $2.5 trillion. But he's got rates about where he wants them. He's got the balance sheet on its way down, and he's normalizing. And what happens? The stock market crashes 20% between October 1st, 2018 and December 24th, 2018. That was the famous Christmas Eve massacre where the stock market fell 3% in one day. But the Fed's still tightening. The Fed tightened like a week before the Christmas Eve massacre. They tightened into the weakness. They were getting very close to crashing the stock market. They took it down 20% in 3 months, getting close to crashing it. So what happens next? First week of January, Powell comes out. Okay, we're not going to raise interest rates anymore. We're going to be patient. These are all these code words. We're going to be patient. Then he starts cutting rates. Then he starts QE. I forget if it was 8 or 9, whatever. Lost track of QE. He starts QE 8, let's say. And then that takes you into 2020. And here comes the pandemic and rates go down to 0. And the balance sheet goes to $7 trillion. They were back where they were in May of 2013. Except worse, because now the balance sheet was even bigger than it was then. A complete failure. So who thinks they're going to be more successful this time? They're doing the same thing. It's going to happen faster this time because the market saw that whole 7-year fiasco from May to 2013 to May 2020, a 7-year round trip failure. The same thing's going to happen, but it's going to happen faster this time because the market knows that the Fed doesn't know what they're doing. So the Fed's tightening into weakness. One of two things is going to happen. And it's not clear which, but it's going to be one or the other. They're going to keep tightening and keep tightening, keep tightening, try to get a handle on inflation and crash the stock market. Or they're going to lose their nerve, back off on the tightening, and then inflation is just going to rip, which will also crash the stock market. So take your pick, but it's going to be one or the other. But this idea of a soft landing is nonsense. The 2021 thesis was that, inflation grew. Part of it was base effects because, the way the government calculates inflation, it's monthly data compared to the year before. So it's year over year, monthly, then annualized. And so one could easily explain inflation in April, May, June 2021 because you were comparing it to 2020, which was the worst recession since 1946. But the base effects would run off in September, October, November. But the inflation persisted, even though the base effects were gone. So now it's like, okay, this is real inflation. It's coming from somewhere else. It was coming from the supply chain, which the Fed can't do anything about either because the Fed doesn't drill for oil. They don't build pipelines and they don't grow wheat. The Fed can't do anything about any of those things. And that's where the war and the sanctions and the continuation of COVID played a role. So, I say you can have your own views, but you can't have your own data. The data is clear. The inflation is here. The supply chains are getting worse. But these supply chain disruptions didn't start with the war. They didn't even start with the pandemic. They started with Trump's trade war beginning in 2018. I found a very good book on that written by Lorianne LaRocco. And what's interesting about her book is that she finished it in late 2019. So it's almost like a controlled experiment. It was pre-pandemic. It's easy to say that the pandemic disrupted the supply chain, which it did, and the war disrupted the supply chain, which it did. But here we have a very rigorous study of what was happening to supply chains before either one. And the answer is they were a mess. They were a mess back then because of tariffs on China and China redirecting soybean purchase orders from the United States to Brazil. That sounds easy because Brazil grows soybeans. Well, guess what? You got to get the ships to Brazilian ports. You got to rearrange all the logistics lanes. That was happening already. Pandemic made it worse, and now the war makes it even worse than that. Yeah, the world is breaking up. We're decoupling. Globalization is over. There'll be a new form of it. It's not the end of world trade, but you're going to see, maybe the Five Eyes, UK, US, Canada, Australia, New Zealand, and friends in Western Europe form a new trading bloc, but exclude China and Russia. It'll be a little bit more like the Cold War. I talked to Paul Volcker about this, but here's what happened in the 70s. Now, it started as cost push inflation. It was the Arab oil embargo in 1973, after the 1973 war, the Israel-Arab war. Then the Arabs threw the embargo on us. The price of oil quadrupled. It went from $3 a barrel to $12 a barrel. It sounds cheap, but that's a 300% increase. And then we had a severe stock market crash and recession in 1974, which at the time was the worst since the Great Depression. We've had worse ones since, but at the time, that was the worst recession since the Great Depression. Then we come out of that, and along comes the Fed, and we went off the gold standard. Nixon had an easy monetary policy in 72. It was a little earlier for his reelection effort, et cetera. So here comes the inflation. But what happened along the way, and then you had another Arab oil, actually an Iranian oil embargo in 1979 after the Ayatollah took over. So there were double oil shocks. That was supply-driven cost push inflation. But along the way, it morphed into demand pull. It morphed into a demand-driven inflation. Now, I lived through it. I mean, I was a young, up-and-coming lawyer at Citibank and a senior officer living in New York City. And that was the world where if you wanted anything, new furniture, TV set, vacation, whatever, you dropped everything, ran out and did it because the price was going up so fast. So that's instructive in two ways. Number one, it shows that the Fed's always behind the curve. It shows that these things can persist a lot longer than people expect. But in my view, most importantly, because I think things are going to happen more quickly now, it shows inflation morphing from cost push to demand pull, morphing from something on the supply side to a psychological shift on the consumer side. And Volcker crushed it, but at a huge cost. Unemployment was about 11%. He took interest rates to 20%. How does that feel? Mortgagors and student loan holders and others, 20%. You're talking about 40% on credit cards in that world. And people forget, doesn't inflation, don't you have high growth or whatever, at least, or low unemployment? No, we had stagflation. We had inflation and high unemployment. There were 3 recessions between 1974 and 1982. We had 3, 1974, 1980, and 1981, which lasted until 1982. And by the way, people lost confidence in the dollar. In the late 70s, Jimmy Carter's Treasury issued what they call Carter bonds. The U.S. Treasury issued debt in Swiss francs. Now, it was Treasury debt. You had the Treasury credit, but it was denominated in Swiss francs because nobody wanted dollars. That's how bad things were.
The thing I would point out is that there are bull markets and bear markets, and in basically any tradable instrument or commodity, or I consider gold to be a form of money. But what we're really talking about when we say, gold is up, what we're talking about the dollar price of gold. And I view it as a cross exchange rate. People talk about the dollar, the euro dollar exchange rate. Well, there's a dollar gold exchange rate, and that's the dollar price of gold. So they're just alternative forms of money where people get to express a liquidity preference or a credit preference, if you will, if you're concerned about if you're losing confidence in the dollar. But the first great bull market was 1971 to 1980. It lasted 9 years, and gold went up 2,200%. The second great bull market was from 1999 to 2011. Gold went up at just a little under 700%. But in between, you had a bear market from 1980 to 1999. It's a long one, almost 20 years. Gold dropped from $800 to $250 at the bottom in 1999. And we had a second bear market starting in 2011. Now, I had a very interesting conversation with Jim Rogers. Jim is one of the great commodity traders, money managers of all times. And we were down in Dominican Republic at Casa de Campo. This is around 2014, but the bear market started in 2011, but it really fell off a cliff in 2013. So I said, Jim, what do you think of gold? What are you doing? He goes, well, I own it, of course. And he said, I'm not selling, but I'm not buying right here. And he said something that just hit me right between the eyes, and it stayed with me. And of course, he's right. He said, gold's going to the moon, but nothing goes to the moon without a 50% correction along the way. And if you look at the high in 2011, $1,900, approximately, and where was the bottom of the bear market? It was $1,050 on December 16, 2015. Nobody knew it was the bottom at the time. But if you look at that drop down and you use $250 as your base, because you need a base, so you had basically the run from 250 to 1900 was $1,750. Go down 50% from there, it's $825. 1900 minus 825 is 1075, and the bottom was 1050. So Jim totally stuck the landing. Like at 1050, okay, there's your 50% retracement. Now that's the bottom. Now it's going up, and the sky's the limit. Well, we're not overheated at all. I've got gold at I would put it at $15,000 an ounce before 2025. But as I point out, if you're going to $15,000 an ounce, you got to get to 3,000, 5,000, and 7,000 first. So there's plenty of room to run, plenty of room for profits. But when I say things like that, I want to be clear. There's a lot of analysis behind it. I don't just pull a big number out of the air and for publicity, because I could care less. But if you just took the average, and there are a couple ways to think about it. Just take the average of the two prior bull markets I mentioned. So 71 to 80, 9 years, 2,200%. 99 to 2011, a 12-year bull market, about 700%. Just take the average. You don't have to go to the higher of the two or extrapolate. Just take the average of those two bull markets. You would say, okay, well, the next bull market is going to be a little over 10 years, and it's going to go up. It's going to go up 1,500%. So using that as your base, just take the average of the two. You say, all right, 10 years from 2015, that puts you out to 2025. And at 1,400%, it puts you at $15,000 an ounce off a 1050 base. So that's just history. But there are other ways to think about it. Now, I don't know if there'll be a gold standard or not, but I do know that gold will move, the price of gold will move in the direction of where it would need to be if you're going to have a gold standard. And I talked to Paul Volcker about this, and he agreed. If you just took the money supply, so just take M1, which is pretty widely accepted definition of money supply. Take it for the U.S., the ECB, UK, Bank of Japan, and People's Bank of China. There are other entities you could include, but that's over 75% of global GDP right there. Divide that number by the official gold, which is about 34,000 metric tons, a little bit less, you come to $15,000 an ounce. So if you're going to either have a gold standard or even use gold as a reference point for money, if you need to restore confidence in the dollar, the implied non-deflationary price is $15,000 an ounce. So what I find interesting is that if you use just the history of the last two bull markets and average them, or if you use a rigorous calculation, what's the implied non-deflationary price? Interestingly, they come out in the same place. I don't think they have to. They're two different methods, but they both point to $15,000 an ounce sometime over the next 3 or 4 years. It is a moving target. The numbers I gave you are based on current levels, but if you keep printing money, you need a higher price if you want to reference gold and not cause deflation, which they don't. You're going to need a progressively higher price of gold. One thing people forget, they look at the dollar price in absolute dollars. So it went up $100 an ounce, or I expect before long it'll go up $1,000 an ounce a week. But each dollar increase is a smaller percentage increase. So people look at the dollar. Yeah, it's real money. It's nice to make the money. But if you go from $14,000 an ounce to $15,000 an ounce, that's only a 7% increase. I mean, You can do that in a week. So my point is, it's still $1,000 an ounce, good for the holders, but the percentage increase gets smaller and smaller as the absolute dollar amount gets larger and larger. So $15,000 sounds like a big number from today's perspective, but as you go to 10, 11, 12, it gets to be a progressively smaller percentage increase, and therefore more likely. You need to see it logarithmically to see it, a less hyperbolic curve. So logarithmically is the right way to think about it, but in dollar terms, the percentage increase gets to be pretty small at those levels. And when I say $15,000 an ounce, I don't think I'm stretching. I mean, could it be 25,000, 40,000? I mean, just take my monetary equivalent. If you use M2, and by the way, when I used M1 and did that math, that's with 40% backing, because historically 40% has been a high level of backing. If you take M2 at 100% backing, you get to 50,000 an ounce in a heartbeat. My numbers, I think, are conservative. They could be much higher. But the thing I would point out is that the Fed dug a hole and they can't get out of it. And I said all along, but certainly, 2014, 2015, et cetera, as they did the taper and then they did the liftoff and then they raised rates and all that. I said the Fed is trying to get out of this. They're trying to normalize the balance sheet, trying to normalize interest rates. But I also said they won't be able to do it. And that's exactly what happened in the fourth quarter of 2018. Between October 1st and December 24th, 2018, the stock market dropped 19%. It was 1 point away from a bear market at that stage. And then you had the Christmas Eve massacre. And that's when Jay Powell threw in the towel. He got religion. He said, okay, first he said, we're not going to raise rates anymore. Then he said, we're on pause. Then he said, we're actually going to cut rates. And then 9 months later, he said, we're going to end quantitative tightening, which was reducing the balance, the money supply. And then in September 2019, they started QE4, which is that was before before the recession, before the depression, before the pandemic. They were already in QE4 and cutting rates again. So they can't get out of it. Now it's worse. So they prove that the failure is manifest. They prove that they can't get out of it. And what can they do? By the way, on monetary theory, I mean, you say, what's the secret behind I think it's garbage, by the way, but you say, what's the secret behind it? Well, the secret behind it is if you can issue debt and collect taxes in the money that you print, you can force people to accept the money because they need the money to pay their taxes. And if they don't pay the taxes, they end up in jail. Now you can get extensions or do whatever, but at the end of the day, if you manifestly refuse to pay your taxes, they will come and put you in jail. And the point is, it relies on state power. It's really a neo-fascist concept. It relies on coercion, the point of a gun, jails, and state power to enforce the confidence in money. Now and they say that. I mean, I've read Stephanie Kelton. She's the bright light. I mean, this goes back a long way, but I've met her, read her books and her book, I should say, and her articles. But they're very explicit about that. Now, I think that's completely wrong because there are so many workarounds and so many ways to get out from under that kind of state power. But they do rely on state power at the end of the day. So that's why it has this neo-fascist element.
Disinflation, definition, but maybe even deflation is the opposite, at least for the time being. Inflation is the end game. It has to be because there's no way out from under the debt. But right now, people are still worried about inflation. Prices are still going up. I put gas in my car just like everyone else, so I'm well aware of it, eggs, bacon, et cetera. But inflation has been coming down steadily since June of 2022. So about 7 months in a row, 8 months in a row. It peaked then. We all know what gas prices were doing and so forth. But the reason is kind of interesting. And inflation, nominally, prices are going up. Okay, so that's inflation. But it can come from two sources that are opposite. One is from supply side shocks, supply chain disruption. We saw that in 1973 with the Arab oil embargo over the Arab-Israeli war at the time. The price of oil quadrupled, et cetera. That was a supply shock. The thing about supply side inflation is it's self-negating. It burns itself out. So, the old saying, and it's true, the cure for high oil prices is high oil prices. In other words, when things get too expensive because of supply disruption, people can't afford them, businesses close, you get layoffs, you go into recession, and prices come down pretty quickly after that. The other source of inflation is from the demand side, and this is a completely different dynamic. We saw this in the late 70s where prices are going up, but people have some bargaining power. So unions are on strike. They're getting higher wages. I worked at Citibank in the late 70s, early 80s. they used to give us raises without asking. They just say, here's another $20,000, because they knew that the cost of living was going up. We would all change jobs if they didn't pay us more. So, but that feeds on itself. So the supply side disruption tends to snuff itself out. The demand side inflation tends to feed on itself. It gets out of control. And then we saw what Paul Volcker did with interest rates in 1981, where he took them to 20%. He caused a recession in terms of tight monetary policy to snuff out the inflation. But otherwise, if you don't do that, that just runs away. Now, the inflation we saw in 2022, late 2021, 2022, it was real. It wasn't transitory the way Jay Powell said. And, you know, the price of gasoline doubled, more than doubled, and all the other complaints you hear, you know, the filling up your Ford F-150 pickup truck went from $70 to $140, which for a lot of people that meant they couldn't eat or couldn't, you know, go out. It was killing demand in, you know, entertainment, shopping, retail, a lot of other things, which again tends to snuff it out. So that has happened to a great extent. Starting in June 2022, that was the peak, and this inflation has been coming down. Now, it's still too high. The Fed's not done. We're going to see at least one more interest rate hike, maybe, but they're going to leave one more on the table. We'll see what happens in June. I'm not forecasting June, but I would not rule out another interest rate hike in June after the May hike. So, because Jay Powell's like thinking, how many times do I have to say this? He's given 9 speeches since August 2022, August 26th at the Jackson Hole, then September FOMC meeting, November FOMC meeting, end of November, a speech at the Brookings Institution, December FOMC, congressional testimony, you know, et cetera. And every time he said the same thing: inflation is job one. We've got to get unemployment up. Believe it or not, we're going to have a recession and unemployment's going to go up. Sorry about that, but we've got to get inflation under control. And until we do, and what's under control mean? Well, it's 2%. That's their goal. Well, it's come down from 9 to 5. Nice job, but 5's still a far cry from 2, and it gets harder as you go along. And they're searching for what they call the terminal rate. So the terminal rate, no one knows what the number is. I don't know because Jay Powell doesn't know, but the terminal rate by definition it's a rate that's high enough that it brings inflation down on its own without further rate hikes. Because so far they've been raising rates and inflation's been coming down. Okay, that makes sense. And they can keep raising rates and it'll come down more. But is there a level where, you know, we're there, now we can sit tight, the famous pause, and inflation will keep coming down? Now you don't know because it's not a controlled experiment. You can't like do it twice. But they're getting close. So whether it's 5.25, 5.5 remains to be seen. But that's the terminal rate. But then Wall Street came up with this narrative, oh yeah, as soon as they're done hiking rates, they're going to cut them. This is the famous pivot we've been hearing about for over a year at this point. No, as far as they're concerned, forget rate cuts in 2023, maybe mid-2024, we'll get back to you on that. But there's one wild card in the deck, which is, that's the Fed's plan. So I just gave you the Fed's game plan. And it's not, you know, you don't need a crystal ball. They tell you what they're going to do. All you have to do is listen, although a lot of people don't. Wall Street makes up their own version of that. But the idea of rate cuts following hitting the terminal rate is, well, rate cuts go down, so dividends look higher, so buy stocks. You know, Wall Street is always buy stocks. That's always the punchline. But they might cut rates late in the year, not because it's their plan, not because they want to, but we could be in a very severe recession. And that, at which point, because the Fed's always late, you know, they're always following the market. They never lead the market. If they've already raised it, let's say they may already be at the terminal rate, not know it. And so if they keep raising, which I expect they will, they may throw this economy into a very severe recession, at which point they may have to cut rates, not because it's in the playbook, but because, you know, unemployment goes up to 7%. And but that gets back to the first question, Constantine, which is what's next. Disinflation may be deflation. The answer is diversification. Everyone goes, oh, we know that, you know, diversification. But they know the term, but they actually don't know what diversification is. And I'll give you an example. I run into people all the time. They go, well, Jim, I'm fully diversified. I have 50 stocks in 10 different sectors: telecommunications, semiconductors, consumer non-durables, metals and mining. And I go, you're not diversified. You may have 50 stocks, but you're in one asset class called stocks or equities. And they're all going to go up together or they're all going to go down together. And the more stressful the condition, the more reason you have to be concerned about it, the higher the correlation. You know, on any given day, some stocks go up and stocks go down. But when you dial the stress meter up, they all tend to move together. So I don't care about your 50 stocks, your 10 sectors, that's not diversified. So what does real diversification look like? Have a sleeve of equities if you want, that's fine. I would say I look hard at oil, natural gas, natural resources, agriculture. Again, kind of equities that have hard assets behind them that will do well in inflationary times or even in recessionary times, because you need all those things no matter what. Then a slice of real estate. I wouldn't be in commercial real estate, but residential real estate, income producing real estate, farms, etc. That's good. I have a big slug of cash. And people go, well, cash doesn't have any yield. Well, lately the yields, you can get 2-3%, on like a CD. But even in a simple savings account, it is quite low. It's kind of less than 1%. But people don't understand the value of cash in a couple of respects. Number one, in a deflationary environment, we're not there yet, but we could hit that if the recession gets bad enough. Cash could be your best performing asset. It doesn't go up in nominal terms, but it goes up in real terms. If you have 2% deflation, your cash is worth 2% more in terms of purchasing power. But the real value of cash is optionality. And this is not well understood. I shared an office with Myron Scholes for 6 years, so I see options under the pillow, so to speak. But if you're the one with cash, when things, first of all, it'll definitely preserve wealth. So if things are falling all around you, your cash will be what it's worth, unless you're in Silicon Valley Bank. It's a separate issue. But although they got bailed out. But so it'll preserve wealth, even if it's not a high performer. It'll do very well in deflation. But the real benefit is when everything else is falling apart, you're the one who can go shopping. So it's kind of an at-the-money call option on every asset class in the world. Everyone's selling everything in a panic. You can bide your time, watch it go down, look for a bottom, and then say, okay, now I'll buy these things down 30% or 40% or 50% from where they were. Some alternatives. I have a number of investments in private equity and venture type situations, and they're risky and they're not liquid. But some of them will do very well. Some of them have done well, so that's nice. And then a slice of gold. And I recommend 10%. Because people, they put words in your mouth. They go, Jim Rickards says, sell everything and buy gold. I've never said that. Not a good strategy. But 10%, yeah. People hear the government say, the economy's fine, or, unemployment's near an all-time low, which actually statistically is true. And they kind of nod and go, yeah, it's all good. And then reality is the stuff that hits you in the head like a 2x4. The propaganda is positive. We can talk about that in a little more detail. The reality is harsh, and reality wins. And there's a very good book on this by Robert Shiller, Nobel Prize winning economist at Yale University. I'm not a huge fan of your garden variety PhD economists, but there are some good ones out there, and he's one of them. He wrote a book about, 2 years ago, maybe a little bit less, called Narrative Economics. He said, we got all the models and Phillips curve and wealth effect and various quantity theory of money, and some have a place, some are more valuable than others, but don't underestimate the power of a narrative. A narrative is a story. It's basically it's a fancy name for a story, but a story that persists, that grows. And interestingly, in epidemiology, of course, we've just come through a pandemic. There's a model called the SEIR model that stands for susceptible. Are you susceptible to a virus? E for exposed. Are you exposed to it? I, are you infected? Did you get it? And R, did you recover? The difference between I and R are people who died. But it's a model, and it's mathematically based, and it's empirically validated of how viruses spread exponentially. And you can also use it to forecast how a virus is going to go. Well, what Schiller did, he took that model, moved it over to economics, and took a narrative kind of like a virus, not in a negative sense, but just as something that spreads. And it can be very powerful, and then eventually may die out or reverse, but it can be powerful in the meantime. That much I knew, but what I learned from the book that I hadn't really thought about is that narratives don't have to be true. They can be true, and they can be very powerful, but a narrative can be false and still be powerful. If it's the self-fulfilling prophecy, if enough people believe it, it sort of becomes the reality to some extent, even if it's based on false premises. He gives an example during the Great Depression. The Great Depression really was two technical recessions, but there was a period from 1929 to 1933, election of Franklin Delano Roosevelt. Then there was another period from 1933 to 1937. The 37 and 1940 part we leave aside for this purpose. But during the first part of the Great Depression, unemployment was high, output was dropping, trade was dropping. It was a very, very bad time, no doubt about it. But not everybody was out of work. Not everybody was poor. There were a lot of people with a lot of money at the time. But it was felt that being ostentatious was poor form. It's like, okay, I'm lucky I have a job, I've got some money, but I'm not going to buy a new car, buy a big house, or flash it around or whatever, because it's really not considerate of all the people who actually have fallen on hard times. Well, that was the narrative, but it's the worst possible economic advice, because it's precisely the fact that people with the money should keep spending that kind of can boost the economy out of the depression. So by people saying, well, even though I have the money, I'm not going to spend it because it's poor form, we're actually prolonging the Great Depression. Now, when FDR came along, he was elected in 1933, became president in 1934, the psychology turned 180 degrees, and all of a sudden, the Democratic campaign song was "Happy Days Are Here Again," and FDR seemed to solve the banking crisis and so forth. And all of a sudden, it became okay to spend money. Well, in the middle of the Great Depression, 1934 to 1936, those were some of the strongest years ever for the stock market. And unemployment did come down a lot. Now, the problem is it came down from like 25% to 15%. Well, 15% is still, painfully high, but it was a big move in the right direction. So he describes how the narrative flipped from don't spend money, it's poor form, to, go spend money and help the economy. None of that is taught in business school. It's not taught in economics. It can be modeled using this epidemiology model, but it doesn't fit into any of the standard macroeconomic models, but it's powerful stuff. And so today what's going on is that the White House is trying to push a narrative, and they're failing badly. But they'll say, if you listen to the deliberations among White House officials, some of the stuff leaks to the press, and I know some of these people. It's like the economy's great, unemployment's really low. We've created all these jobs since the pandemic, but we're doing a really bad job of messaging. The point is, they're inside the White House, they're frustrated that the positive economic story is not getting out. The correct analysis is that there is no positive economic story. The economy is in terrible shape. The problem is not the messaging, it's the message. And this is why I say the propaganda from the White House that things are great is at odds with the reality, which is things are not great. Let me give you some specific data points, because as I say, I don't like to make statements like this without backing it up. Number one, the inflation was going up long before the war in Ukraine started. So if everything was great until February 27th, and then Russia invades, and then all of a sudden the inflation goes up. All right, let's talk about it. But that's not true. This inflation goes back to late 2021. It was persistent in the fall. We all remember the Fed and the Treasury saying transitory, transitory, transitory. And then finally, I think Jay Powell was testifying before Congress. He said, it's time to retire the word transitory. So that was his way of throwing in the towel. And Janet Yellen admitted she was mistaken also. So it predates the war, number one. Number two, energy prices are going up because there's a war with Russia. Well, I wonder why that is. Well, the reason is not because Putin invaded Ukraine. It's because the U.S. counterattacked with financial sanctions. Now, bear in mind, go back to January 21st, 2021, when Biden was sworn in as president, and then went back to the White House. What was the first thing he did? He closed the Keystone XL pipeline. This is a pipeline that would bring oil from Alberta, Canada, into the United States, where it would connect at a hub. I believe it's in Kansas, but somewhere in the central United States. And then the hub distributes it to the entire country. So he shut down that pipeline, which curtailed the supply of oil from Canada. Then ended new leasing, oil and gas exploration leasing of federal lands, handicapped the fracking industry, took a number of other steps using environmental tools, climate alarm, government subsidies, et cetera, to basically, to the extent possible, shut down the U.S. energy industry as much as possible. Now, you can't shut down completely, of course, but everything happens at the margin. And then we end up with oil prices doubling, or tripling, really, from $40 to $120 in under a year, which is comparable to what happened in 1973 with the Arab oil embargo. And then Biden wakes up and says, guess we need more oil. And so he wants to reopen leasing. I said they shut down. They did, but he wants to reopen it. He's begging Saudi Arabia to pump more. Saudi Arabia is kind of not returning his phone calls. He's begging Venezuela to pump more. Oh, great. The greatest pariah dictator in the Western Hemisphere, and we're begging him for oil. So why don't we drill our own oil? Because we were a net exporter up until 2021. And then Biden came in and we lost that edge and became a net importer, including recently buying oil from Russia. They curtailed that for political reasons, but that's kind of where we got to. So you wonder why the price of energy is going up. In other words, this damage was self-inflicted, but don't be misled by the headlines because they're, again, this narrative, but they're not actually doing it. So the point being, the price increase and the inflation in the U.S. has very little to do with Putin and everything to do with the U.S. handicapping its own energy industry, begging dictators for oil, and the influence of the climate alarmists. And by the way, that whole crowd want higher gas prices. They want gas to be $7, $8, $9 a gallon because they expect that will accelerate the transfer to electric vehicles and make the electric vehicle more attractive relative to the internal combustion engine. Now, that's another fantasy. It won't happen. We don't have time to go through all the physics of it. And, output of energy by weight, gasoline compared to batteries and the pollution of batteries and the fact that, we don't have the charging stations. And even if we did, where's that electricity coming from? Oh, coal. It will never happen. But meanwhile, they're destroying the U.S. economy in pursuit of an ideological point that will never actually happen. Another example of propaganda versus reality. Narratives are powerful, but reality is more powerful. Powell did not say, we're going to raise rates until core PC is 2%. He didn't say that. What he said was, we're going to raise rates until it's acting in a restrictive way on inflation, and inflation will come down on its own because rates will be high enough to cause that. At which point we the Fed will pause. And you say, well, when are you going to cut rates? He was like, the pause could be a year. So you're talking, forget this Fed pivot nonsense. I mean, you're talking 2024, if then, before they cut rates. But in the meantime, so they've got to get rates high enough. So they're going to go, 75 basis points in November. December, who knows? We'll know closer to the date. It'll either be 50 or 75. Some talk about 50, but it doesn't matter. I mean, it's going up. Probably going to go up. I have the calendar for 2023. There's a meeting February 1st and another one in late March, I think March 22nd. They'll probably raise up both of those. They're going to get rates up to five-ish. At that point, they probably will have achieved the goal of bringing core PCE down, but they will also have destroyed the economy in the process. It's like I remember in Vietnam, the old saying, we had to. This is the latest in a long string of Fed blunders since 1913. Seems to be their specialty, but that's what they're doing. They could at least pause now, or maybe even cut rates. If everything I said is correct, and obviously I think it is, or I wouldn't be saying it, but if we're on the verge of a global liquidity crisis, as revealed by the Eurodollar futures curve and the Treasury yield curve, and negative swap spreads and Treasury bill auctions with the yield to maturity below what the Fed will give you for a phone call, I mean, all those things are happening. That's hard data. And it's a very, very troubling sign, last seen in 2008, by the way, before the Lehman Brothers meltdown. If all that's happening and the fundamental signs are also weak, which we just saw in third quarter GDP, which is based on net exports, which won't last. How are you going to drive a trade surplus with the strongest dollar in 20 years? Good luck with that. I mean, nobody can afford our stuff, and we're not buying anybody else's stuff. So with the economy going into a recession on its own, with a global liquidity crisis brewing, why on earth is the Fed raising rates at all? When I talked to my editor about this, go back a year ago, so November 2021, every headline you looked at, website, commentators, supply chains breaking down. There's no, they couldn't get cream cheese to make cheesecakes at Junior's, the world's most famous cheesecake place, and on and on and on, like a long list. And then last spring was the baby formula shortage, which was serious. I mean, mothers couldn't feed their children, so it was very bad. But I found some really, really interesting research that, because everyone says, well, yeah, COVID messed it up and the war in Ukraine messed it up. Well, that's true, but it didn't start there. This started in 2018 with Trump's tariffs. Because I'm not here to debate the tariffs. I actually think the tariffs were a good idea, but that was the start of the supply chain breakdown. Because when Trump put tariffs on, started with appliances, washing machines, refrigerators, and stuff, and then solar panels, and then technology, and then they just kept piling on. But you have to look at what China did in response. The U.S. and Brazil are the two largest exporters of soybeans. China is the world's largest importer of soybeans. Mm-hmm. China was buying all their soybeans from the United States just as a way to kind of make it up a little bit. Like, well, we got to buy the soybeans anyway. Why not buy them from the U.S. to keep the U.S.-China trade deficit under control so it doesn't become too politically toxic? Well, as soon as Trump threw on the tariffs, China retaliated by moving their soybean orders to Brazil. Stop buying U.S. soybeans. Well, that's not a phone call. I mean, you're talking about vessels, port facilities, agriculture, trucks. How do you get the soybeans to the ports? How many do you grow? Where's the fertilizer coming from? Et cetera, et cetera. And all those parties, the shippers, the cargo, the insurance companies, and so many people involved, banks, letters of credit, it's just a lot involved. They don't like short-term relationships. They say, okay, I'll do it. I want a 5-year contract. And China said, okay. So they reconfigured all those transportation lanes to get the soybeans from Brazil. All of a sudden, you're a U.S. soybean grower. You say, well, what do? Well, we started selling them to the Netherlands because the Netherlands needs soybeans too. So now instead of shipping them from like Port of LA to Ningbo and near Shanghai, we're shipping them from Port of Houston to, I don't know, France, Marseille or someplace, or Rotterdam. So the point being, you completely scrambled all these supply chain relationship, and they break down that it's not that it's the end of the supply chain. So there's nothing new about supply chains. We can document to the Bronze Age. What was new, beginning around 1989, was supply chain science. The combination of vastly improved computing power, artificial intelligence, new algorithms, and more sources of data that could be put together and used by experts to optimize and make the supply chains more efficient. That was new. And it kind of began with the fall of the Berlin Wall and the collapse of the Soviet Union. And, Berlin Wall fell in 1989. Soviet Union dissolved in 1991. I talked to the guy who, this is a worldwide endeavor, but he was probably the single most responsible individual for all the significant developments in the supply chain in the last 30 years. And he said to me, Jim, you have to understand, it took us 30 years to build it. We blew it up in 3 years. It's not going to come back overnight. It's going to take 10 years or more to rebuild it. And what I talk about in the book is supply chain 1.0, which is 1989 to 2019, and then supply chain 2.0, which kind of starts now, but is going to go indefinitely because it's going to take a long time to put this together. It's it's like dropping a vase and it breaks in 1,000 pieces. You can't put it back together. You got to go buy a new vase. And that's what's going on with the supply chain. There will be a supply chain, there always is, but the new supply chain will look very different from what we've just come through. Because the whole 30 years of period I'm describing was built on efficiency, lower cost, lower cost, lower cost. It was kind of the Walmart model. So yeah, just-in-time inventory, everyone knows about that, but there's something called cross-docking. That's where a truck pulls up at a warehouse and you unload it. Instead of putting the stuff in the warehouse, you move it to another truck that then goes to a destination. The stuff never goes in the warehouse. Inventories are very expensive. They're costly to finance. You got to move the stuff around. It's called picking. Pick the stuff off the shelf with you. I used to drive a forklift, so I know a little bit about it. And put it on a truck. I used to unload trucks too. So, hey, I've got 7 suppliers. Why don't I cut it down to 3 and do bigger contracts with each one and get lower unit costs? I've got 5 transportation lanes. Why don't I cut that down to 2, get everything to Los Angeles and Seattle, as the case may be, et cetera. And they did it for 30, and they got costs lower, and Walmart and Amazon were the champions of this, but everyone else was doing it. But they missed something. What they missed was that while they were getting those unit costs lower for consumers, there were hidden costs, and the main hidden cost was you were creating greater frailty. This whole system was subject to a massive breakdown. So, what happens if you have 2 suppliers and they both go on strike? What happens if you have one port of entry and it's backlogged? What happens if you've got cross-docking in warehouses and there aren't enough trucks? We need 80,000 drivers, 80,000 drivers. Wish they'd hire them instead of these IRS agents. But the point being, it is breaking down all across the board. Now, can it be put back together? Yes, but the biggest difference between 2.0 and 1.0, this goes by different names. Janet Yellen called it friendshoring, and Macron called it a constellation of nations. I use the term a college of nations, collegial club, if you will. So you'll still have trading partners, you'll still have outsourcing, you'll still have transportation lanes, but it'll be members only. It'll be basically democratic, kind of liberal republics, Western Europe, the EU, of course, US, Canada, Australia, New Zealand, Japan, and some others. India, I would expect to be included. Friendly nations, but China's out. We're decoupling from them. They're decoupling from us. This isn't US driven. The US is participating, but this is what China wants too. Both sides are decoupling as fast as they can. China can develop its own network, maybe Central Asian republics, some Southeast Asian suppliers and so forth, but they're going to lose customers. Well, most of their customers actually in the United States. We won't buy their stuff, and we won't sell them our stuff, particularly high-tech stuff. So the world's going to break, and these new clubs are going to be formed, and there will be trade and there will be transportation lanes, but it'll be much more restrictive. Now, will prices be a little higher? Yes, but it'll be more secure. So the way I describe that, if you buy insurance on your house, or I buy insurance on my house, you don't want your house to burn down. You hope it doesn't. But if it does, you don't think your insurance premiums are a waste of money. Like when you write that check, you're like, that's money well spent. When you pay higher prices for consumer goods, the delta between the old price and the new price is your insurance premium for a more reliable system. And also, there's a big national security component to this. Now, there's another problem. It's even scarier, and this is a central banker's worst nightmare. I talked about how the Fed is blundering because they're raising rates too high, too fast, etc., and they are. But the Fed has always said, we don't worry about inflation. We don't like it, but we know how to get rid of it. We just raise rates, and maybe they got to raise them longer and further than people expect, and maybe it's painful. There are costs involved, but they can kill inflation just by raising rates. They don't know how to stop deflation. I mean, how do you stop deflation? You can't raise rates. That'll make it worse. You can go to zero, but that doesn't, once you're at zero, you're at zero. QE doesn't work, by the way. It's been tried to the tune of like $9 trillion, but the empirical evidence is that it's just, they do QE by buying bonds from the banks, and the banks take the money and give it back to the Fed as excess reserves. That money never goes to the economy. What good does that do? And the answer is it doesn't do any good. So you can take rates to zero, but you're stuck. Could you have negative interest rates? In theory, yes. In Europe, Switzerland, and Japan did. But there's no evidence that it provided any stimulus. I mean, they did it, but it's like an experiment that didn't work. The problem with deflation is there's nothing a central bank can do, and it does feed on itself, and it does get worse, and that is a central banker's worst nightmare. However, quick footnote, we did see this in the 1930s, well, between 1929 and 1933, during the first phase of the Great Depression. It was the Hoover administration. Then Franklin Roosevelt came in 1933. And Roosevelt faced exactly the same problem. I mean, he shut every bank in America on like his second or third day in office. By executive order, he closed every bank in America. Can you imagine the President of the United States today, I don't care if it's, Biden or Trump or anybody else, Democrat or Republican, issuing an order saying every bank is closed as of now. We'll get back to you when they're going to reopen. And that's what FDR did. To break the banking panic, but he still had the deflation problem, and the Fed couldn't do anything. I talked to Ben Bernanke about this personally because Bernanke wrote a book on this, and I read the book, and I said, Mr. Chairman, I said, here's what I think you said. Did I get this right? And he said, yeah, that's it. You understand it correctly. But the Fed couldn't and didn't do anything. So how did FDR break the back of deflation when the central banks were powerless? The answer is he raised the price of gold. He devalued the dollar against gold and raised the price of gold 75% from $20 an ounce to $35 an ounce. And that worked because it wasn't about rewarding holders of gold. In fact, he had confiscated all the gold beforehand, so it was like insider trading. But the idea of raising the price of gold was really to devalue the dollar so you could get the price of corn, wheat, steel, oil, get the price of everything else up. And it worked. In the middle of the Great Depression, from 1933 to 1936, the market boomed. I mean, the economy did very well, but it was starting from such a low level. It was still depressed, but it did much better. You know, the Democratic theme song was Happy Days Are Here Again. Then in 1937, the Fed screwed it up again and caused a second recession in the Great Depression. And that's why they call it the Great Depression. But the devaluation of the dollar against gold worked. Nothing the central bank could do would work. Deflation is very troubling and should be to central bankers, economists, and everyday citizens, everyday Americans, because it raises real interest rates really steeply. It feeds on itself, and there's nothing central banks can do about it. And the only thing that has ever worked is devaluing the dollar against gold. So that's one reason to have gold. But we're looking at a global recession. And those are rare. As I said before, it's one thing if Germany has a recession or Japan or the US, but usually there's another economy or economic group that's doing okay or at least better and can kind of pull everybody out of the rut. But global recessions where everybody's declining are rare. And that's what's happening. And that's what we had in 2008. So the U.S. is heading for one, and we've just talked about that at length. Japan's in a recession. Europe's in a recession. China's in a recession. India's, having some tough times. And a lot of this is dollar related. All the other countries I mentioned, Switzerland, India, China, Japan, have all seen their US dollar reserves go down. And everyone's like, oh, they hate the dollar. They're dumping the dollar. No, it's the opposite. They don't have enough dollars. So they're selling treasuries to get dollars to bail out their own banks because there's a dollar shortage. So the fact that you see those dollar reserves coming down does not mean that they hate the dollar. It means that they need dollars, that they're short of dollars, and they're so desperate that they are selling treasury securities to get dollars to bail out their own banking systems. So we're well on the way to a global recession. And if you say, well, you got communism, socialism, capitalism, all these different economic systems, all part of this globalized system, how could they all be on the same wavelength at the same time? Well, the common thread is the dollar. It's the US dollar. About 60% of global reserves, 80% of global payments. It's the benchmark for every other currency. So when you talk about the euro, you're quoting dollars. You're saying it's $1.05 or $1.04. Gold, you say, oh, it's $1,800 an ounce, whatever. The point being, even when you're talking about a commodity or currency that's not a dollar per se, you reference it in dollars. Same with oil, world market, it's all dollar oriented. So the dollar is the thread that runs through the whole global system. And it's a partial explanation for why everything's falling apart at once. What's the optimal asset allocation method? Well, the key is diversification. And when you say diversification, people roll their eyes and go, oh, of course, everybody knows that diversification is good and all that. But the problem is they don't understand what diversification is. And I run into people all the time and they go, Jim, I'm highly diversified. I own 50 different stocks in 10 different sectors, telecommunications, semiconductors, mines and minerals, consumer non-durables. So I'm highly diversified. And I say, no, you're not. You may have 50 stocks, but you have one asset class, which is stocks. And they're all going to go down together or go up together as the case may be. But particularly in times of stress, they become highly correlated. So having 50 different stocks or ETFs or whatever is not diversification. It's just having a whole bunch of bets in one asset class. So what does real diversification look like? Well, you should have some, 10-year treasury notes, or if they're a little too volatile for your taste, look at a 5-year note or a 2-year note. That will basically give you very, the credit secure. I'm not doubting the credit of the United States, but that will give you a deflationary hedge. If we get into disinflation and deflation where interest rates are coming down, which I do expect, you're going to get very good capital gains on those notes, or you're going to be very happy with the coupon in the meantime. Real estate, definitely. Not so much commercial real estate, too soon for that, but multifamily housing, residential real estate, farms, other kinds of income producing real estate for a slice. Good slice of cash, maybe as much as 30%. People hate cash. They go, I don't get a yield on cash. Cash is a waste of my time, etc. It's true that it has very low yield, but number one, it performs very well in deflation, which we talked about. But more importantly, Cash is the opposite of leverage. It reduces the volatility of the rest of your portfolio. So if you have volatile investments in the wings, cash is it's like a bar connecting to two ends of the barbell. It has very low volatility, but most importantly, it gives you optionality. If you see stock markets crashing and burning the way I expect, the way I described, the person with cash can go out and go shopping in the ruins. And by the way, Warren Buffett Berkshire Hathaway has over $130 billion in cash. Why does Buffett have so much cash? Well, he sees what I see. We're looking at the same thing, which is a kind of meltdown where the person with cash can basically go shopping for bargains. Definitely a slice of gold for the reasons we talked about. That'll be your inflation hedge. But 10%, people always say, Jim Rickards says, sell everything and buy gold. I've never said that. I don't think that's a good idea. But 10%, yes, that's a good slice. Private equity, if you can have access to good deals, that's a separate category. And so a model portfolio, you'd have a slice of treasury notes, a slice of cash, have some stocks, but I would focus on, for example, energy, BP, Exxon, Mobil, Shell, Marathon, this Green New Scam thing, forget it. It's a big deal, from a policy point of view, but it's infeasible. I've studied the science very closely. It's going to go away. But in the meantime, if you bash the oil and natural gas companies, but you're going to need the oil and natural gas, which we do, then those stocks are going to do well. Real estate, I mentioned, and gold. So that would be a really diverse portfolio that would have 5 or 6 different asset classes. And some will outperform others. Some will do better in inflation, some will do better in disinflation. But that's the whole idea with this much uncertainty. And your winners will outnumber your losers. And cash is like a thermostat. You can reduce cash and buy a little more gold, or reduce cash and buy a few more stocks if that's warranted. So that's what I think an ideal portfolio is. The future is very positive for gold. You have the normal vectors. Supply is flat, but has been for 6 years. Demand is going up. Central banks have flipped from net sellers to net buyers. That's a big deal. Retail and institutional interest is higher, so that's good. Geopolitical threats, don't need to say a lot. From the U.S. perspective, Iran, China, North Korea, Venezuela, Russia, you name it. So that's the vector. But the biggest driver right now is what I referred to a few minutes ago: negative real rates. Because gold, as a form of money, which is how I view it, competes with other competes with other instruments, treasury bills, et cetera. Well, if they have high yields and gold has no yield, you want the treasury bills. But if interest rates have negative yields and gold's just flat, gold looks more attractive. So that's the main driver, and that's going to continue. Everyone's like, well, the gold is up, gold is down. So what do you mean when you say that? And they're talking about the dollar price of gold. And it's like, okay, so the dollar price of gold is up or down. That's really a cross rate. That's no different than talking about the euro US dollar exchange rate or Australian dollar US dollar exchange rate. If you think of gold as money, and I do, then the dollar price of gold, with gold measured by weight, not as another currency, it is another form of money, but with gold measured by weight, it's a cross exchange rate. When the price goes up, I would say that what's really happening is the dollar is going down. In other words, I think of gold by weight. I'm interested, do you have a ton? Do you have 50 kilos? Do you have 5 ounces? Whatever you have as an individual investor, as a bank, I think of it by weight. Because when someone says gold's really going up, I said, well, no, the dollar's going down. You need more dollars to purchase a fixed quantity of gold, which means the dollar's worth less. And when people say gold's really going down, I say, no, the dollar's worth more, and you need fewer dollars to purchase a quantity of gold. When people talk about price, the first thing they do is they're really talking about dollars. There's a euro price for gold, but the world market is based on dollars. You're privileging the dollar as the numeraire. The numeraire is your counting system. Is it yards, inches, feet, whatever. And if you put the dollar first and say gold is in dollars and it's going up or down, I think you have it backwards. I think you need to put gold first by weight. And then if it's worth more, the dollar's going down. If it's worth less, the dollar's going up. And so when you say gold is going up, let's say it went to $2,000 an ounce, everyone say, oh, the price of gold went up, just went up 10%. Well, did it, or did the dollar go down? The way I would phrase it is, it used to be $1,800 to get an ounce of gold. Now it's $2,000 to get an ounce of gold, or your dollar got you 1/1800th of an ounce. Today, it only gets you 1/2000th of an ounce. In other words, gold didn't do anything. It's a metal. It's an element, atomic number 79. What happened was the dollar got stronger. So a stronger dollar is a lower dollar price for gold, and a weaker dollar is a higher dollar price for gold. So when people talk about gold going up, what they're really talking about is the dollar going down.
We have new numbers regarding how much gold central banks are buying, 400 tons in Q3 this year, records and numbers we haven't seen since the 80s. Yet we don't know some of those mystery buyers. Obviously, the theories are they are Russia and China.
Now China is non-transparent. Russia is much more transparent, although Russia is starting to be opaque a little bit because they're in a war. But you can see the inflection point is 2010. So from 1970 to 2010, it's a long stretch, 40 years, central banks were net sellers. It didn't mean everybody sold everything, but Switzerland's down 1,000 tons, U.S. was down 1,000 tons after losing 8,000 tons, or sorry, 11,000 tons between 1950 and 1970. It was down, down, down. 2010 was the year that central banks became net buyers. Now, it doesn't mean every central bank was buying gold. It does mean that they were selling a lot less and others were buying more. And some of the buyers are Mexico, Kazakhstan, Philippines, Vietnam. We know China's a big buyer. We don't know exactly how much. Russia was a big buyer. That is continuing. Now the new players, Iran's non-transparent, but we know they're buying gold. Turkey is buying a lot of gold. Japan had a bunch of gold all along. They never told anybody about. Literally 1 month, their reserves went from 600 tons to 900 tons. Well, you know the market. You can't buy 300 tons in a month, not one country in one order. But they had it all along, but they decided to reveal it, put it on their balance sheet. So Americans don't seem to like gold. I'm not sure Canadians feel much differently, or others around the world. But central banks sure do, and I think that tells you something. There's huge demand for dollars all over the world, not because of the currency, but because of collateral, because of treasury bills. Banks need treasury bills to pledge as collateral for derivatives. It's the best collateral in the world. And if you don't have it, you're not going to be able to leverage your balance sheet as much as you would like. You're not going to be as profitable. You're not going to be able to support lending and investing, which is what banks in theory are supposed to do. To support the bloated balance sheets and to support the derivatives, you need collateral. And the better the collateral, the more leverage you can have. The best collateral in the world is a treasury bill. And so there's a mad scramble for treasury bills, which means there's a mad scramble for dollars to buy treasury bills. And that is coming from European banks, it's coming from Chinese banks, and banks around the world, but primarily European and Chinese. And that's not going away. So it's funny to hear people think it's funny to hear anyone talk about a dollar collateral shortage, like, hey, haven't you flooded the world with dollars? Hasn't the Fed printed $9 trillion? And the answer is they have. But that's not the measure. It's a high multiple of that. It's the dollar value of all the collateral. Because in the repo markets, I pledge the collateral to you, and then you pledge it to somebody else, one of our colleagues, and then she pledges it to somebody else, et cetera. That collateral gets pledged 50 times and supports not $1 a balance sheet, but $50 a balance sheet for $1 of collateral. And so you restrict the collateral, you're restricting the balance sheet. The dollar as a reserve currency will not be deposed overnight, but as a payment currency, there's a difference between a reserve currency and a payment currency. Anything can be a payment currency. If I want to pay you with baseball cards and bottle caps and you're okay with that, then it's a currency. So all of these organizations are working on new payment systems right now, and they're going to start to roll them out this year and later. So that's going to be a radical change in how we pay for things. I can give you 20 reasons why the dollar should go down, but I'll give you one big reason why it won't, which is the demand for collateral. And so that's keeping the dollar constant, which is keeping the dollar price of gold constant, because gold doesn't change and the dollar's not changing. Now that'll break, and that'll break in favor of gold, meaning the dollar will get a lot weaker. It'll have to, but it's going to take a few months at least, because the U.S. economy has to get weaker, which it is. The Fed will figure this out maybe by September, next September. And then they'll ease a little bit and they'll try to weaken the dollar to try to give the U.S. economy a boost, but we're not there yet. So it's going to be, now that doesn't mean the price of gold is going down a lot. I'm just saying it's not going to go up a lot. It's going to chug along, kind of sideways, but when it breaks, it's going to break big to the upside because the dollar is going to go to the downside. But that's probably at least still a few months away, maybe longer. Just at a very high level, I would say that there are a lot of difficulties, a lot of challenges. We'll talk about all of them in detail. You know, people put words in your mouth and kind of get the reputation as this doom and gloom guy. You know, Jim Rickards is always talking about the end of the world, which I don't. I never use that expression. But I make the point that, yeah, despite the difficulties, we don't have to be victims. We're not helpless. We don't have to curl up in a ball. The key is to see it coming. If you can see things coming, you can deal with them accordingly. You can get through them, not only preserve wealth, but actually make money. I always point out the example of Hugo Stinnes, and people go, who's that? He was an industrialist in Weimar, Germany in the early 1920s, and he could see the hyperinflation coming long before the middle class, long before anybody else. He went out and borrowed an enormous amount of Reichsmarks, that was the currency at the time, and just bought industrial assets, coal mines, vessels, natural resources, etc. So here comes the hyperinflation. He gives it a little time. He pays back his debts. I would say pennies on the dollar, like a millionth of a penny on the dollar, in other words. But he paid it back. They were sweeping the money down the sewers, but he paid back his debts and kept all the assets. And he became the richest man in Germany. And my German's not very good, but his nickname was the Inflationskönig, which means the inflation king. So there are other stories like it, Joseph Kennedy in the 1929 crash, but here's a guy who lived through the greatest hyperinflation of any modern industrial economy and ended up as the richest man in Germany because he saw it coming and made the right move. So again, we're not helpless. We can do things about it. But the key to empowerment, as I say, is to see it coming. That's where the analysis comes in. And you're like, gee, Jim, are you smarter than everybody else? Of course not. There are a lot of big brains around, but people have flawed models. There's a lot of behavioral psychology behind it, the confirmation bias or believing the future will resemble the past, which it usually does not. And so if you're going to stick to those models, you're going to get really bad results. It's hard to think of an institution that has a worse forecasting record than the Federal Reserve, the U.S. Federal Reserve, with the possible exception of the IMF. They're both pretty bad. I mean, you could almost take the Fed forecast, do the opposite, and be just fine. There's more to it than that, but they just stick to these really bad models. But if you understand how the economy really works, if you understand it's a complex dynamic system, all I've done is I've taken complexity theory, which has been around for a while. I mean, you can say 13 billion years because the Big Bang was the ultimate complex dynamic paradigm shift or phase transition. But the science of complexity, understood in mathematical terms, really dates to the early 60s. But it's been used very successfully in physics. It has a lot of applications. All I did was bring it over to capital markets. I looked at capital markets and said, wait a second, here's one of the most complex dynamic systems you can picture. And then there's nothing more complex than the human brain. So you're putting humans on top of capital markets. You've got complexity squared or some exponent. And those models work brilliantly. But try getting anyone to understand it or do that work is difficult. But again, the point is, if you have the right models, and I would include behavioral psychology, a good dose of history, complexity theory, and a few other branches of applied mathematics, you can get very good results. But if you stick to, the Phillips curve and non-accelerating inflation, unemployment rate, and a lot of other nonsense the Fed uses, you're gonna get it wrong. Does the future resemble the past? With some probability, some degree of distribution probability. Not always. I mean, and maybe less frequently now than ever. And they also assume that prices move continuously. Prices go up and down, of course, but markets don't move continuously. Or if they do, it's when you don't care. When you do care, they just gap. They gap down or they gap up. You miss it, you blink, and it's at a completely different level. It's been repriced. Now, you can still get in and out, but you've either made a lot of money or lost a lot of money in the blink of an eye. So when you take those characteristics, and this is how I started deconstructing it, if you will, and said, well, look, markets are not efficient. That's nonsense. They don't move continuously and slowly. They gap up and they gap down. And if you're not ready for that, you've missed the boat. Nothing's risk-free. So why don't we start there? when I started identifying those factors that, in my view, were incorrectly applied, and you say, well, what looks like that? Well, the answer is a complex dynamic system. A system that produces hurricanes and tornadoes and lightning bolts and power outages and earthquakes and tsunamis. Those are all examples of the results of complex dynamic systems. An earthquake doesn't sneak up on you. It just the ground falls out from under you instantly. And that's what happens in markets. So then I said, well, maybe that's a better model. Of course, it is. Things evolve all the time. Another tool, intellectual tool, applied mathematical tool, uses Bayes' theorem without getting too much in the weeds. And I learned Bayes' theorem at the CIA because I always say, if you have all the facts, a smart high school kid can solve the problem. The intelligence agencies and others, and people in capital markets, have to solve problems when you don't have all the facts. But you have no choice. In national security or defense, it's literally life or death. On Wall Street, it could be your fortune or your client's fortune. So you don't have the luxury of just throwing up your hands and say, "Well, I'm going to wait till I get more facts." That's what Janet Yellen did, but that doesn't work in the real world. She's kind of detached from that. So how do you solve problems when you don't have all the facts you need to really solve the problem, and you know it, but you have to deal with it anyway because it's coming at you? Well, Bayes' theorem says assign an initial probability, a priori assumption. Just not make it up, but do the best you can, recognizing that you're going to fall short, that you've got missing pieces in the puzzle, if you want to put it that way. And if you have no facts at all, and it's a binary outcome, give it 50-50. It's not quite 50-50, but red or black on a roulette table, it's a little less than 50-50. It was close enough. You said it's either going to be red or black, don't know which. I'm going to give it a 50-50. And then what you do, and this is what statisticians hate, you update it based on subsequent facts. As new facts come in, you put them back in the model, you update it, and what you'll discover is that your probability either goes up or down. Well, if it goes down more than a certain amount, you discard it. You say, well, that's wrong. I just do it again. But if it goes up, what you're doing is making it more and more likely that your assumption was true. And so eventually you can get up to the 80-90% level. Now that's not 100%, but it's pretty darn good. But there's a tension, which is, okay, as you're updating, and this is something that was explained to me by Henry Kissinger. So imagine a simple graph, and the vertical axis, the y-axis, is the probability of a certain outcome, and the x-axis is a timeline. Basically, you convert that into the amount of information you have. How much information do I have? How much time do I have to make a decision? Well, at zero, at the outset, you have no information, or very little. But you have a lot of time. You have a lot of degrees of freedom. But as you move across the x-axis, as you move down the timeline, what you discover is you get more and more information, which is a good thing. So that curve is going up. But you have less and less time, fewer degrees of freedom. That curve is going down. So when you get all the way to the other end, it's like, hey, I have perfect information, but it's too late. It's over. I miss either, war started, or I lost all my money, or something bad happened. So what you look for is the sweet spot in the middle, call it the Kissinger cross, where I have enough information to be smart, but enough time to have degrees of freedom and be able to act. You look for that sweet spot in the middle, and that's when you act. And, with a little humility is a very good tool, a good addition to the. They, $9 trillion of QE didn't do any good. I mean, how does the Fed do QE? They buy bonds from banks, give the money to the banks, and the banks give it back to the Fed as excess reserves. What does that do for the economy? Nothing. Zero rates, again, it doesn't work. They don't have the tools. We've been talking about recession, inflation, deflation, but the one thing we haven't spoken about yet, you kind of just referred to it, is there a global liquidity crisis coming? And a liquidity financial crisis is different from a recession. Sometimes you can have one without the other. 1990 we had a recession, there was no crisis. 1998 we had a crisis, there was no recession. The economy was fine in 1998, but the financial world almost came to an end. Sometimes they come together, and that's what happened in 2008. We may be looking at a scenario like that. By the way, 65 trillion in foreign currency derivatives, yeah, but try 1 quadrillion in total derivatives. I mean, that's foreign currency. That was the focus of the BIS paper. But when you get into interest rate swaps and commodity swaps and swaptions and all the rest, that's 1 quadrillion, which for people not familiar with the Q word, is 1,000 trillion. So you pointed to 65 trillion, and you're right, that's FX. but there's 1,000 trillion or 1 quadrillion of derivatives off balance sheet of the banking system, supported by collateral, a little sliver of collateral, and there's a dollar shortage, and that's getting ready to implode. Well, a couple things you can do. One thing, I would increase my cash allocation. A lot of people hate cash. They're like, it doesn't have any yield. Why would I do that? I'm missing out on whatever, Bitcoin or stocks or whatever. Cash is extremely valuable. Number one, it performs very well in disinflation and deflation. Deflation, it could be even with a very low nominal yield, it could have a much higher real yield in the world when prices are going down. So it's a good deflation hedge. But more importantly, cash gives you optionality. If taking everything we just described about a potential stock market crash that could be 30% or more, a global liquidity crisis that could be worse in 2008. I mean, there are plenty of signs of both of those things. Well, if you're the one with cash, first of all, you're not going to lose money on cash. You will on stocks and other asset classes, but not cash. And then when this drawdown comes, when this collapse comes, you're the one who can go shopping. You can go out in the wreckage and say, oh, well, here's a good company. It's down 90%. I'll buy some of that. By the way, the person with the most cash in the world is Warren Buffett. Berkshire Hathaway has over $130 billion of cash. Now, why do they have that? The answer is Buffett sees the same thing I see, the same thing we're talking about right now, which is in a highly uncertain world with a lot of vulnerabilities, and that's exactly what we're describing, that come home to roost, and that's how I see 2023. Cash will preserve wealth and then give you the opportunity to pick up bargains. I'd also have a slice of gold. I recommend 10%. People always want to put words in your mouth. Jim Rickards says sell everything and buy gold. I've never said that. I don't think it's a good strategy. 10%, yes. Now, if you have 10%, sit tight. It'll serve you well. If you don't, you might want to get some gold, because a lot of what we're talking about is going to play out in foreign exchange markets. In crypto, there's nothing there, but they've replicated this infrastructure, and so a lot of the wealth that's been generated in crypto is because you own a crypto exchange, or you own a lender set. Now that's all imploding. It's kind of a replay of 2008, except instead of Bear Stearns, Lehman Brothers, Fannie Mae, Freddie Mac, and Morgan Stanley was hanging by a thread. It's FTX most prominently, but Genesis is kind of considering bankruptcy, etc. So all that is collapsing. So Bitcoin's not an exchange. It's not part of that infrastructure. It's just a coin. The best analogy I've been able to come up with, I have a lot more to say about it coming out of communications theory, but it's like a casino chip. If I walk into a casino, put my money on the roulette table, and the croupier gives me chips, I can gamble them, I can play with them, I can make money or lose money, but when I leave, I go to the cashier and get my dollars back and walk out. If I take the chips outside the casino, they're worthless. I can't pay for dinner with casino chips. So cryptocurrencies are casino chips. You're in the crypto casino. Some people made a lot of money, and I know some of them personally. A lot of people have lost a lot of money. More have lost than made money, which is how casinos work, by the way. So eventually they'll all go to zero, but in stages. But what's collapsing right now is the infrastructure. China's non-transparent. Russia is much more transparent, although Russia is starting to be opaque a little bit because they're in a war. But you can see the inflection point is 2010. So from 1970 to 2010, it's a long stretch, 40 years, central banks were net sellers. It didn't mean everybody sold everything, but Switzerland's down 1,000 tons, the US was down 1,000 tons after losing 8,000 tons, or sorry, 11,000 tons between 1950 and 1970. It was down, down, down. 2010 was the year that central banks became net buyers. Now, it doesn't mean every central bank was buying gold. It does mean that they were selling a lot less and others were buying more. And some of the buyers are Mexico, Kazakhstan, Philippines, Vietnam. We know China's a big buyer. We don't know exactly how much. Russia was a big buyer. That is continuing. Now the new players, Iran's non-transparent, but we know they're buying gold. Turkey is buying a lot of gold. Japan had a bunch of gold all along. They never told anybody about. Literally in 1 month, their reserves went from 600 tons to 900 tons. Well, you know the market. You can't buy 300 tons in a month, not one country in one order. But they had it all along, but they decided to reveal it, put it on their balance sheet. So Americans don't seem to like gold. I'm not sure Canadians feel much differently, or others around the world. But central banks sure do, and I think that tells you something. They're preparing for what we're talking about, which is a world where the dollar as a reserve currency will not be deposed overnight. But as a payment currency, there's a difference between reserve currency and payment currency. I think they can be a payment currency. If I want to pay you with baseball cards and bottle caps and you're okay with that, then it's a currency. So when we see the BRICS Plus, the Shanghai Cooperation Organization, OPEC Plus, China individually, all these countries are the Eurasian European Economic Union, which is Putin's answer to the EU. All of these organizations are working on new payment systems right now, and they're going to start to roll them out this year and later. So that's going to be a radical change in how we pay for things. The thing is, people don't understand reserve currency. It's not as if the People's Bank of China has pallets of $100 bills stacked up in the basement. Reserve currency means a currency of denomination of securities. So what China does have are treasury bills and treasury notes. So the key to being reserve currency is not the currency, it's the bond market. Do you have a large, safe, liquid bond market? And if you do, then people will buy those bonds. What else are they going to do with the money? But that's much harder to replicate. Well, they can have a currency backed by gold, at least not the Chinese yuan, because the problem is there is no Chinese yuan bond market of any size, number one. Number two, they have no rule of law. I mean, no, I wouldn't trust the Chinese or the Russians for that matter. And the U.S., the problem with the U.S. is that we had a good thing going. I've always said the world will not destroy the dollar. The United States will destroy the dollar through our own policy blunders. And when you freeze the assets of the Central Bank of Russia, I don't want to debate the war in Ukraine, that's a big subject, but when we freeze the assets of the Central Bank in Russia, and you're the Central Bank of Turkey, Saudi Arabia, China, you're like, hey, how do I know that next week the U.S. isn't going to not like something I did? Are they going to freeze my assets? So little by little, yeah, at the margin you get out of. The Silicon Valley Bank was taken over by the regulators on March 10th, but you can see it coming. It was in distress. There was $40 billion pulled out of that bank in one day on Thursday, March 9th, the day before it was taken over. $40 billion just hit the road, just left. It was a complete collapse. And then you get all the corruption, insiders selling stock before the crash. Mary Daly, the chief regulator, president of the Federal Reserve Bank in New York, she's running around doing LMNOP plus and pride flag and all this stuff. Fine, that's it's a free country. You can do that if you like, but she wasn't running the bank, and she knows nothing about risk management. She's a labor economist, protege of Janet Yellen, came up the ranks, but knows nothing about risk management or actually running a bank. So it just got worse, and then here comes Credit Suisse, right? The entities are always different, the currencies are always different, but the dynamics are very much the same. And the one thing I can say to our viewers is that this is not over. There's been a little bit of a sigh of relief. Stock market rallied a little bit toward the end of beginning of April. And okay, that's a normal reaction. But any thought that the problem's been solved, the bailout's complete, you're not going to hear more, is just not true. There's more coming. Get ready for it. I'm just saying that there are more dominoes waiting to fall.
As you may have noticed, as we're going into a recession, and I suspect unemployment's going to scream. I see more people here in Arizona standing on street corners and all this saying, veteran, please give me $1 or something like this. And I just can't believe they're wasting their time begging for money. This guy was a pretty young guy standing on the corner begging. And it's not good. So we're heading back, I think, into the 1920s. Very good chance we're in the middle of a drought right now. This is a 90-year cycle in bad weather.
The really interesting part about this, and again, we can come back to the specifics, is that the dominoes falling is a good metaphor. It's, if you got 100 dominoes, you knock the first one, they're all going to fall. That's just physics. So how do you stop that? How do you stop that crisis? Well, you truncate, you drop a steel wall between two dominoes, and this one hits the wall and this one's still standing. But that's the bailout. But the problem is each crisis tends to get bigger than the one before, which means each bailout gets bigger than the one before. My question that I'm wrestling with, are we now at the point where the needed bailout is bigger than the capacity of the central banks?
Today, everything's changing so rapidly, but this time the tom-tom beats are getting louder and louder and more. Do it now, basically. My concern today is for Kim and I, our real issue is social unrest. The gap between the rich and poor is now excessive. And that leads to revolution, civil rioting, and all this. When you print all this fake money and you rig it for the rich only, what that produces is a wave of intensified and widespread social unrest, disjointed political upheaval, dangerous extremism, punishing trade wars, and sweeping isolation.
The crash we see is in the commercial business sector. Again, the higher interest rates go, the more money people have to pay on their loans, particularly if they're variable, which, by the way, just happened up in Canada. They got a lot of variable interest rates up there, and they just raised the interest rate there 50 basis points. So we believe, we're forecasting, the big downturn is going to happen in 2023. It takes time for this stuff to take hold. But then don't worry about it, because when 2024 comes, they're going to lower interest rates in the United States in time for the presidential reality show.
The most important thing today are credible sources. And now the alarm is getting louder as technology changes. We have to go to a solution pretty quickly because people are on suicide watch right now. Well, first of all, everybody can do something, but they won't. And that's the problem. The reason, who stole my pension, there was plenty of money in it, but nobody did anything. They just stole it. The people did nothing. It's like I said, when the crash came in 2008, not one of those guys went to jail. They got paid bonuses. So there's something rotten inside America. And I think the problem with many Americans is they're complacent. They expect, well, it'll heal itself again.
The higher these interest rates go, all the people with adjustable rate mortgages, all the businesses that borrow money that have variable rate mortgages, the governments that are deep in debt now paying more because interest rates are going up. So yeah, the equities are going to go up, but this economy is going to keep going down. And it's going to go down big, and it's going to go down hard. Not right away, but it's going to progressively get worse and worse and worse. UK traders now expect the BOE's next rate rise to be its last in the cycle. And in the Eurozone, markets expect rates to peak at 3.25% in the summer, up from the current level of 2.5%. 2.5% when you're looking at inflation rates in the UK and the EU that are killing the people. These interest rates are nothing compared to inflation. So when you put the inflation numbers compared to the interest rates are still deep in negative territory. It will prop up the equity markets, but the economies are going to go down.
The question I ask people is, if we go into a depression, how will you do? That's the question. So I set it up since 1971 when I saw Nixon take the off the gold standard, and I started getting smarter. So I'd say, I don't trust my government. Like, don't fight the Fed. And I was like, can the Fed print oil? Can it print gold? Can it print water? Can it print food? No. But people go, oh, don't fight the Fed. So the thing I always say is, in a worst case scenario, how will you do? So that's why I own oil wells, not oil stocks. I own cattle for the food. I own gold mines. I own my own company. My company, Rich Dad, did better in the downturn than ever before. So it's not recession-proof, but people wake up more and they say, I better get financially educated. And I never stop studying. It's the most important thing you can do. Problem with Americans is we're dysfunctionally optimistic. We live in a don't worry, be happy world. And that's not the real world.
So now we're dangerously close to the point where, as the crisis gets worse, it's no longer, oh, gee, let's wait for the Fed to bail it out, or let's wait for the ECB to bail it out. You get to the point, I think we're there, where you say, no, these guys actually can't stop it. And you lose confidence in the currency itself. The crisis is the dollar itself, and there's no way to bail out a dollar crisis.